A wonderful good morning, ladies and gentlemen, and welcome to NAGA and Markets for Breakfast. My name is Alex Duwadari, and today is December the 17th, 2019. It is Tuesday, and it is the second day of the new week, maybe the last real trading week of the year, where we are past these big macro risks, the Brexit decision and the trade deal between U.S. and China. However, things are not really looking so. Moving, I would say, other than stock markets. That's the only thing that continues to just race upwards. And we want to have a look at markets and really put a little bit more sense and framework around all of that to see where this is going. So, nope, here's where we want to go. So, first of all, let's have a look at the S&P 500. What we saw yesterday was a continuation of a movement to the upside, and that is really something that is very, very, there's nothing stopping these stock markets. And there are some reasons. I mean, first of all, when we look at the calendar, what we saw yesterday was that the data out of Europe absolutely disappointed. And in fact, we got the weakest data out of Europe since 2013. It's the worst slump of the Eurozone manufacturing PMI, most noticeably. And that is not really, really good. So it's very clear that the Eurozone economy is closing this year for with the worst results for 7 years now, or 6 years, and that's really not a positive sign for, or at least it doesn't support the story that, hey, we've hit the bottom and things are recovering again in Germany, for example. And absolutely not. So let's have a look at the manufacturing here out of Germany, for example, just so you have a look at the chart. Sometimes this helps a little bit more to understand what's going on here. If that lovely chart would be opening for me. So far it's not. Here we go. So that was, everything was very, very negative since the beginning of 2018. And then we had this little bit of a movement here where we say, oh, finally we're seeing some sort of a bottoming out. But no, we're actually going back down again. And that is not really a good development. Nonetheless, the stock markets continue to go up, but that really has other reasons. So first of all, what we want to look at is where is she here? Lisa was saying that in other news, and that has to do more with the liquidity on the U.S. stock markets, but in general, it's an idea how the central banks are influencing, or in fact actually manipulating, the price movements on markets. So in other news, today's 30-day term repo operation from the New York Fed was oversubscribed, an indication that demand for funding through beginning of 2020 remains ravenous. So what it means is that the Fed is shoving money into the markets in really big time fashion. By the way, the Fed will reach its highest balance sheet again, the way it looks in a number of weeks again. And when it says oversubscribed, it means that as much as the Fed is providing liquidity, there's more demand for liquidity. And you got to ask yourself, why? Why the heck is it like that? And it's not, we don't know the real reason, but this stimulus, as Lisa is posting here, is suppressing volatility, which is attracting new flows to risk assets from systematic strategies and driving prices higher. So that's just how it works. You get the money cheap, and then you can, you just invest it according to your mandate. And many of investment vehicles these days are also passive, and the money just gets shoved into these markets, and then this is how we get these high movements. Now, something that was different in the US to Europe. So first of all, we talked about here the European, no, this is Tuesday, we want to still show Monday. The European PMIs, they were very bad. By the way, the UK manufacturing was also quite bad. I'll get to that in a moment. But in the US, we saw positive numbers. And that's another reason why you can see that the US continues to show strength, and why also the European currencies yesterday saw a little bit more of a challenge here. So from a economical health perspective, U.S. is still doing a lot better, even though we lack any real news or any details about this trade deal to come. So let's have a look at the UK also. Wait a second. Let's open up the charts here. First of all, the euro dollar. What we saw yesterday, or what we're seeing now, is that the euro dollar is still holding quite well despite the negative data out of Europe. Let the chart just load here. Here we go. And so you can see we're still above the 111, but we're still, not really moving anywhere. That's really the takeaway here. It's not really having a directional pressure into any one direction just yet, even though the strength of the US dollar, and when we look at the dollar index yesterday, the dollar index wanted to show some weakness yesterday, but came back, obviously because in the afternoon, these US PMIs pushed it back up. So there is a chance that we can see actually further dollar strength from here, even though it's absolutely not what Donald Trump wants. But, not everything he wants can happen. So getting to the UK. Now the UK has obviously, yes, we talk about, hey, now we're out of this risk from the Brexit vote or the election, but are we really? Because in my opinion, we're not too much. Like, okay, now we see the market really come back from this big election, frenzy, I guess, euphoria. And now the pound finds itself a little bit in trouble. Why so? Because, first of all, the PMIs out of UK yesterday came in negative. Here in manufacturing, 47.4. So they're not really encouraging by any means. If anything, they're underwhelming. And in fact, the economy contracted there for the third time in the past 4 months. So and this latest decline was the second largest recorded over the past decade. And that means that the likelihood for that this economy is not doing well, but actually has gotten worse in this last quarter, is very, very high. So that is not a positive sign at all for the UK. And then we still have, obviously, the Brexit still needs to be concluded. Just because we had this election, it doesn't mean that the Brexit is just done. And there is a report in the Times and says that the European Union made it very, very clear they will not give in to the Conservatives in the UK or any pressure they might want to exercise on the EU. We had a senior Brussels source saying that the EU will not cut its own throat. So that looks like they're going in for a fight, and we will see that there will be a new lead negotiator from the UK, which is Michael Gove. And what he said yesterday is that he can absolutely confirm that that they will have an opportunity to vote on the withdrawal agreement bill in relatively short order. So let's see how this will continue, but it brings risk back to the table, and that's not really a good development in the UK, or it's not a development for an environment to put money in. So we have an economic struggle, a really, a proven one. And B, we have a fight coming towards them, between the EU and the UK, which is not done yet. On the contrary, what we know now is that the UK will want to leave the EU by any means necessary, and the EU will not give the UK anything, they won't fight for. So that is not necessarily a good fertile ground for growth. On the contrary, that's why we can see that the pound is seeing further downside here, and may in fact retest the 132 level. Remember that 132 was the resistance here earlier in 2018, from where we dropped very heavily. So it's a very important level we're at right now, and if we drop lower, then it better hold above the 131, because then we could very quickly reach the 130 again, which was that dreaded level we couldn't overcome almost all the last quarter, or the current quarter, basically, here, that level. So for the price to shoot back down to the 130, it's probably not going to happen so quickly, not just in a day like this big Brexit candle. But the direction could be very much en route to there, given the overall structure of how things are looking. Now, in any way, what we're seeing is that there is a little bit less volatility, a little bit less stuff going on in the markets. But that could be a bad thing also. Like, if liquidity is thin over Christmas, next week, for example, after the Christmas holidays, typically markets don't move too much, really, or at all. But sometimes they make bigger moves because suddenly there's a burst of liquidity liquidity that actually moves stuff, and that is not necessarily a risk that you want to take, or it is a risk you want to be aware of. Let's put it this way. What else do we have? So what we have is that in spite this fantastic U.S. stock markets that just know one direction, up and up and up and up and up and up, the Dow Jones had a little bit more of a struggle than the other indices yesterday. Why? Because it has Boeing trading with it, and Boeing seems to be needing to stop the 737 production altogether, which is would be a very big blow for them. But that is what the news are telling at the moment. So we'll have to see how that will continue. But I don't think it's like nothing can take this off here. It's just really going up and up. And there were more news out of the U.S. that are just giving more and more confidence. And actually, yesterday when you were looking at the U.S., we see that the word melt up, or the chatter about it, is rising. So new articles mentioning melt up in the last 30 days have been going up very heavily recently again. So okay, we've seen that happen a few times, right? And here where the market actually went up, and here it also went up, continued to go up. But I mean, you have to consider that we're still like at this very highest level ever, with not too much that we know about that situation between US and China. So there is a lack of details, in fact. So the US-China trade deal, we had the foreign ministry in China issuing a statement saying that more trade information regarding the phase 1 deal will be released in due course. So whatever that means, exactly when it's going to be. Working levels officials from both sides are in contact. So and the market's actually taken it as if it's already a done thing and we know all the specifics and everybody's happy. Well, no. And these things can flip-flop. They can change. They can come back, and that's why I'd be a little bit more cautious here personally. But I think the bigger picture is that in case of any dips, setbacks, this impossible amount of liquidity around will just pick it back up. And also what we've seen yesterday was that US data, further US data, like for example the NAHB housing market, it went up very, very strongly, in fact. And when we look at the article here of CNBC, it says the home builder confidence jumps to highest level in 20 years. So yeah, we take loans, we build houses, all of that, and the money is too cheap, and it's very cheap, and it's contributing to asset bubbles left and right. Nobody knows how long this is going to continue to go like that. And it's not said that it's going to crash at some point. It's just something that has happened in the past always, and something that really gives me support in my understanding, in my let's just say classical understanding, that at some point these prices have to find some sort of a rebalancing, is the price of gold. Because in spite of all the risk taking around, gold has not been falling out of love. Gold is holding quite okay. Yes, it's not anymore at the 1500 level, but it's still holding very strong, and it's actually had a very good year, very, very good year. Like, think about it. We started here, somewhere here last year at 1250. Now we're at 1476. So there's a good chance for continuation to the upside, and it looks like that there is a need for some people, at least in the market, to hold and buy gold. Otherwise, gold would have been gone down. So I remain bullish on gold, and this 1480 level seems to be pretty much a resistance area that is right now not possible to overcome, because this risk environment right now is so strong. It would be even odder if gold would go up in with the risk markets, but at least it's not going down with risk markets, but I think if we conquer the 1480 on a daily close level, you see daily close levels are, or weekly even more, are very relevant, because they are a clear sign of commitment and of traders in the market, or participants in the markets. And what we see here is that so far the 1480 level, these recent weeks, we were not able to close any of these candles above that level. So that's why you always see the prices come back down here. But you can also see that before that that was very much a support area. So if we break into the grab of the 1500, seems very much possible, and that's something I'm looking at to see at some point. Now, something that's also been supportive of stock markets growing, in fact, is that China's data are showing signs of it's stabilizing more and more. We talked about the data that came overnight yesterday, and we continue to see rather positive development out of China, and that is rather good. So let's have a look at what the calendar brings us today. So we have unemployment rate out of the UK, average weekly earnings. I don't think that these numbers will, play into too much. Building permits, housing out of the US. Maybe the GDT out of Canada could bring a little bit of an interesting twist here, because if we look at the Kiwi, it's still one of these currencies that is showing more resilience than others and continues to have a good chance to push to the upside. You can see here we're right around that support area in July, and now a resistance area right here, and we could see a reattempt of 66 here very, very soon if the dollar turns down a little bit again. Speaking of turning down again, that's something what we've seen very clearly in Bitcoin, and we talked about it. I mean, I don't even remember a day where we didn't talk about it in the last 2 weeks even. And it has happened. The 7K level has not held any longer. So really, we saw another push to the downside here. We revisited the lows that we had earlier here in late November. And now it gets very, very tricky because the picture remains quite negative. And we saw that this drop yesterday occurred very, in a quick fashion. And now we're here at a lower end. And from my perspective, a retest of that 6,777 looks quite probable. Not just possible, but probable. And therefore, there's probably going to be more attempts to push the price down because the reflex from the 7K back up in a quick fashion, as we've seen it repeatedly before, right? Like every time we went close to, like for example here, we went below the 7,000 and then boom, all the way up back to almost 8,000. And there's no reflex here whatsoever. Now we got to wait for today to confirm if that bearishness will presume, and if it does, the likelihood of actually seeing even lower levels from where we are right now is very, very large. It's not even so slim, and retest the bottom of or the so thought of bottom of last year, that is not too far anymore. It's only about 1,000 or 800, not even 1,000 more, $800 away. So Bitcoin remains pretty much under pressure here and could see further downside. And you can see that other crypto coins are even more under pressure, like Ripple with 10% as it shows here, and Ethereum with almost 9% here in the red. So that is not a possible good development. So long story short, we're still a little bit, I think markets are getting more thinned out in terms of participants. We see that the dollar showed some strength yesterday. We'll have to see like what kind of further news will transpire today. Gold remains pretty much a rebel here. Pound has more reasons of struggle, and we will have Mark Carney speak later today, the governor of the Bank of England. Let's see what he's going to say after this election. It's going to be quite late, so not sure about the impact on the currency market per se, but it's still there. And, stock markets in the US have good reasons, and even though they're idiocratic reasons, but they have good reasons to continue to go up. If we get another good building permits, housing starts today, and looking at the NAHB yesterday, we should actually, then that could give another push to US stock markets, or to the confidence of the U.S. markets and attract more money. So that's also something that's likely to end up in further bullishness here. So that's my overview of the market today. As always, thank you very much for listening in. I wish you a great, successful trading day, and we'll be back here tomorrow morning. Bye-bye.